Good morning, everyone. This is your host, Jack Weixel. I'm going to give folks a few minutes to get on, as it is just top of the hour, and we'll get started here momentarily in about 1 minute. Okay, welcome everyone. Again, my name is Jack Weixel. I will be your MC, host, and speaker today for this quarterly natural gas market webinar brought to you by East Daily Analytics. I'm a senior director here at East Daily and really focused on our natural gas commodity vertical. And we do these webinars once per quarter to inform both clients and the market alike what our view is of kind of the upcoming season and kind of beyond that in terms of where we see the market headed from a supply, demand, storage, and price perspective. So this quarter's topic, we've got a couple themes running here. The first is potential scary surprise this winter, followed by what many could call a potential summer of discontent. And then in the long run, figuring out what we term the long-term LNG puzzle. Let me kind of layer these in and categorize them for everybody so that it's very clear what we're going to be end up talking about. So first thing that we like to look at is the near term. So what's going to be happening over the next 6 months? We did see about 3.9 BCF a day of overall gas production growth, summer 23 over summer 22, which has led to a very handsomely oversupplied market. But what we're looking ahead to in the next 6 months is if we have a warm winter, how is this oversupply going to pan out? And then how severe will market recoil be? So we'll dive into that kind of head first. I think that's very important for folks that are just trying to get acclimated to the current environment. So that'll be our near-term section. Next is what I consider the short term, right? So 18 months. This obviously this upcoming winter, the summer, and then winter 24-25. We will have a tighter S&D as production stops ramping as fast as it had in the previous year. And we will also be experiencing a storage deficit to the 5-year average, which we'll examine in detail and look at the pricing ramifications from that. And then finally, long term. When we talk long term, we're looking at 5 or 6 years out. I think the biggest story long term in natural gas markets is the potential build out of a tremendous amount of LNG liquefaction facilities. So much build out, in fact, that the pipe is not even built out to support these expansions. So, the prospect of some very serious LNG demand becomes a little bit scary once you realize that the pipeline infrastructure is not there yet. And as projects get proposed by developers far and wide, you have to have production to back that up. So the tier 2 basins there will have to step up. It's not just all going to be fed by Permian and Haynesville. So we'll talk a little bit about that as well in the long term. So first, just before we get into the meat of the presentation, just a little explainer on what East Daily Analytics is for those not familiar. We are basically commercial analytics shop, demand analytics shop, and supply side analytics shop. We also do benchmarking for various midstream companies and provide a company briefing on about 24 different symbols, different companies. Our purpose is essentially to help our clients with efficiency and confidence. You may not have endless amounts of time to put reports together and forecasts. So, our job and our commitment to you all is, we essentially build the tools that you need to make your job easier. We are analysts, we are researchers, and we want to help you make hard decisions in whatever the market conditions may be. We deliver A through data delivery, and then B, reports, presentations, and the business intelligence platform. We also have about 15, 16 analysts who are at your service here to answer any questions. And then finally, we have a consulting arm as well, which many find useful. So that's a little bit more about what East Daily is and what we do. There's contact information obviously on the back of this tail end of this slide that we'll get to after questions as well. So let's start off now with production and talk about briefly what happened in 2023 and what we expect to happen in 2024. So this is our month-on-month change in dry gas production for our forecast through the end of 2024. And what you can kind of see here is for the balance of 2023, we're going to continue to see some gains here. The rig count hasn't declined so much that momentum has been completely lost, but we do anticipate that the declines will start to show up right about in January there, and you can see things bottoming out in June with a 2.7 BCF a day delta to last July, July 23. So the upstream environment, the production environment is going to look a lot different throughout 2024 than it did in 2023. A slowdown obviously is imminent, and what we're looking at here, if we go from entry to exit, is basically flat production. So in December 2023, we see 102.5 BCF a day of production on December 2023 production of 102.6. We do anticipate that there will be growth in the Arklatex and Permian basins, but at the expense of more dry gas traditional basins like those in the Northeast, the Rockies, of course, and then the Bakken ended up being flat. Overall, average 2024 production will be down 1.3 BCF a day versus 2023 production. So, what we're predicting is essentially a slowdown, and there's a number of reasons for this, with price being obviously one of the glaring factors. But also, we do believe in the fiscal discipline story from producers, and we do obviously track the rig count and various other elements of production in order to be predictive on this. So kind of a sea change from 2023, but definitely a different type of environment in fiscal year 2024 versus the prior year. When we look at things specifically by basin, I think one of the things that stands out is the Arklatex, which is kind of our proxy for Haynesville. In May, it peaked at about 18 BCF a day, but has since dropped 17.5 BCF a day last month, and we expect it'll be off about 17 BCF a day in December. So that is, we see this kind of like this dip before the storm. And if I go and detail this as it relates to kind of our short-term view here, what specifically do we think is going to happen? you see that dip here that is going to occur kind of in 2024, and then a period of growth. The dip that we've experienced so far has been necessary in order to effectively balance the market. So we think that producers are currently and will do so for the next 2 months or so, cut drilling activity so that again you don't bust through storage inventories, and then we see a kind of a period of growth as we get into mid 2024, spring of 2024, and that balance starts to reassert itself. One of the questions also that we're looking at is a long-term imbalance. So this growth that's occurring in 2024, essentially, is it enough to supply all these LNG projects that are coming in later in the out years? I think that's a big question mark. We've seen the East Texas portion of the ARCLA of the Haynesville grow, but East Texas IP rates are a little bit lower than Haynesville rates, and so one of the big questions kind of going forward long term is whether ARCLA-Tex and the Haynesville can sustain 25, 26, 27 BCF a day of production. So that's something to kind of look forward to as we go into long-term mode, and it's going to become more and more important as we look at the LNG build-out, which is also part of this puzzle, right? So we just shifted from kind of near-term to long-term. I want to make sure everybody's following here because there are important ramifications for both. This near-term slide in production is essentially going to be necessary in order to cure a low price environment and get production back up again when it's really in need in out years. And I say that because here is our LNG forecast. So we look at SPAs, signed purchase agreements, and FIDs as obviously the two biggest factors that facilities will actually be completed. Through 2029, we're tracking 33.2 BCF a day of capacity. That's not necessarily what is going to flow, though. We expect flows in the 31 BCF a day, possibly 30 BCF a day level there at roughly 90% utilization. But I think the important thing to realize here is that this represents about 19 BCF a day of demand growth by 2030 on the kind of the current existing flows that are LNG export flows that are around 12.5 BCF a day. The other thing that this tracks with, and I've noted this before in several conferences this year, is that 19 BCF a day is nearly the equivalent of all U.S. industrial demand for gas. So industrial demand for gas usually is running at about 21, 22 BCF a day. By 2030, you're adding a second entire U.S. industrial demand number out there just through LNG. So this is a big climb, a steep climb. The way we kind of choose to look at it, looking at SPAs and FIDs, is to essentially look at what is an FID, and then what will be soon the expected FID. So, in what I like to call phase 2 of this LNG grow out, we've got several facilities that have gotten FID already. They're all kind of highlighted in yellow. Those include Golden Pass and Plaquemines. Of course, Altamira has already started flowing a little bit of gas down and out of Mexico. So that's reflected in a net export number, but it is still gas that's effectively leaving the supply and demand balance. And you've got a Corpus Christi project in there and Port Arthur as well, along with some floating LNG off the coast of Louisiana. So 1, 2, 3, 4, 5, 6, 7, 8 products, or eight projects with roughly 10.8 BCF a day of LNG capacity. And then once we kind of get out of 2026, then you've got what I call this phase 3 period, where there are other projects that are coming online. And if we look specifically, right, You got Rio Grande, Delphin. You've got Sabine Pass, a third expansion there. Cameron LNG Train 4, Commonwealth LNG, CP2, and then finally Saguaro over in the Sea of Cortez, which could be classified as a Mexican export, but will command more gas out of the Permian. So that's your second big phase, your second big ramp. And this second big ramp we'll look at here in a second is really not going to be possible without some additional pipe in the ground. So that's part of this longer term LNG demand puzzle, which I think is very important to pay attention to as we go through throughout the next couple of years. So let's do it. Let's build this whole thing out. Let's show kind of what, show our notes here on what's driving this this imbalance, right? 2023, we've been long gas all year, right? You've got LEAP, Acadian, Gulf Run, all aiming at kind of like your Lake Charles area. You've got Freeport back online there at capacity of roughly 2.28 BCF a day. Altamira, of course, as I mentioned before, down there with that 2 symbol. And you did have some expansions out of the Permian. So you had Permian Highway, 0.55 BCF a day, and then of course Whistler's expansion of a similar note there aimed at Corpus Christi. So you're long gas, you're building the pipe to get it out of the basin, but plenty of gas available for existing LNG facilities, right? 2024, 2025, we get even longer. So you've got a number of pipeline projects and not as many LNG facilities to utilize. So Golden Pass, of course, and Plaquemines, those symbols 3 and 4 there, come online for a combined capacity of roughly 4.2 BCF a day. But you've got Matterhorn pipeline, an incremental 2 BCF a day coming online in 2024, right? You've also got the LA Energy Gateway, which is a big project. You've got NG3, of course, and then LEAP phases 2 and 3 to add. And so all in all, you got about 4.8 BCF a day of incremental LNG capacity and demand. But you've got 3 BCF a day coming out of Waha and 6.5 BCF a day coming out of northern Louisiana, Haynesville, and associated gas there. So 9.6 BCF a day of pipe to support 4.8 BCF a day of LNG demand. So you're in good shape here. We're still net long in the Gulf in terms of deliverability and production to essentially ramp up to fit in those new pipelines. But when we look at 26 and 27, this is where stuff gets complicated. Look at all these facilities that are coming online. Corpus Christi at the end of 2025, Delphin, Commonwealth, and Plaquemines phase 2, all coming online in 2026. And then Rio Grande, Cameron, CP2, Port Arthur, and finally Lake Charles all coming in 2027. And you see that 18.65 BCF a day number. That's the total cumulative capacity that these LNG facilities can command. But I'm only seeing 9.6 BCF a day of pipe. So there's a mismatch there of, let's just call it, 9 or 10 BCF a day. And so, for the developers, project developers and pipeline developers on this call, midstream companies, et cetera, we're anticipating that if we're going to ship all this gas overseas, that there's got to be some pipeline built, whether it's brownfield or greenfield pipeline. There needs to be more pipeline proposals and projects to build out this supply chain. So you're in phase 3 there, 26 and 27, you're drastically short gas to serve all these LNG facilities. So that's the big unknown. That's the big part of the puzzle that hasn't necessarily been figured out yet. Do we have confidence that it will? Certainly. As these LNG expansion projects reach FID, they're going to need some surety of supply. Just a major market development to pay attention to. And we think the picture will start to get clearer as we get into the back half of next year, in terms of who's going to build, what they're going to build, and where it's going to be located, to kind of deliver into that corridor between Corpus Christi and Port Arthur. So just something to think about. Definitely a crucial element of realizing all this incremental demand and effectively boosting U.S. LNG, U.S. Natural gas production. So that's kind of our long-term story there. I'll reflect back on this in the end, but I guess I should mention now too, if you have comments or questions, there is a way to do that through the chat down on your screen. So send those in, and when we get through, I'll try and answer as many as possible. Let's flip back to the short term now and do a seasonal comparison of what we anticipate to happen this winter versus last winter. This is our forecast. This is the supply side right here. We saw that 3.9 BCF a day of growth in production summer on summer, but this winter, it really starts to slow down. 0.8 BCF a day of growth. Winter 23-24 versus winter 22-23. So total supply there ends up being up about 1.3 BCF a day, as we anticipate a little bit more Canadian gas on its way down to the States. Now, what about demand? Right? Well, demand is an intriguing story. You can see a couple things here, right? Working our way kind of right to left, we'll see a little bump in Mexican exports. Of course, Mexican exports have been healthy all summer long, and we anticipate a little bit of a bump winter on winter. LNG exports, 1.1 BCF a day. This is basically the Freeport return there, and then a little bit of increased utilization at existing facilities. So 1.1 BCF a day there. But then where things get really interesting is this 1.9 BCF a day increase in ResCom. I'll talk to that in just a second, but I want you to keep that in kind of the back of your mind before we go any further. What that means net here is if you've got 3.3 BCF a day in incremental demand on 1.3 BCF a day of incremental supply, you're going to need to pull a little bit more gas out of storage than you normally would. And at the moment, our current calculation here has about 2.1 TCF of gas pulled out of storage this winter, which is a lot more than last winter at 1.7. It's not, if you look at recent history, it's not an exorbitant amount of gas, but if you compare it to last winter, it's certainly a lot more. Now, getting back to that ResCom number. Wink. Here's my little circle here. The biggest risk to this forecast is that we use normal weather to estimate that 1.9 BCF a day of incremental ResCom demand. If you've been hunting around looking at kind of the NOAA Climate Prediction Center and some of the forward-looking forecasts from different providers there, the chances of a normal winter look actually pretty low. At the moment, and I could flash a map on here, but I won't. But visualize in your head the United States of America. Look from kind of the Pacific Northwest over into the Dakotas, into Chicago, the heavy gas-consuming areas of the Mid-Con, and then branch out east into New England and as far down as New York City. And those are all in like a reddish, orangish, yellowish hue, signifying that those areas could very well be normal, warmer than normal this winter. Now down south in Texas, here in Colorado, and then also in the southeast, there are equal chances of a normal weather scenario panning out. But by all intents, it appears that this winter could end up looking more like last winter than a normal winter. There are 151 days in winter, the winter season, going from November to March. If that 1.9 BCF a day of incremental rescom demand does not show up, that means 300 BCF of gas stays in the ground. Um, and what this does, I'll illustrate kind of to y'all on the next couple slides here, is it pushes March end of season inventories close to 2 TCF, which is very scary from a pricing perspective. So that's what I was alluding to in the very first slide there when we looked at this winter's scary surprise, right? Near term threat to prices with March end of season inventories closer to 2 TCF. It's a real thing, and it's a real thing to be aware of as we go through the next couple months. The next 2 weeks, obviously, many areas of the country experiencing a cold front, including snow in Denver here on Saturday night, which will be fun to deal with. But that could be a false flag towards a towards a normal winter when a lot of the longer term signs are pointing towards this above normal winter that we're presented with. So just something to kind of keep in the back of your head and to monitor. Obviously, the easiest way to monitor that is to look at weekly storage withdrawals this winter. But just something to consider going forward. Let's get more to the point and talk about our yield curve, right? So, a yield curve basically plots the surplus or deficit to the 5-year average against price. And those red dots down in the right-hand corner there that I've highlighted are where we're at in the current season. So we're about to end summer 23. And you can kind of see red dots have proliferated around the 400 to 200 BCF surplus level. And the behavior there, at least from a pricing perspective, is very similar to what we saw in the summer of 2020. Of course, completely different conditions, but similar surplus levels, similar pricing levels. As we look out on our supply and demand forecasts, which allow us to calculate where we think inventories are going to be, the surplus conditions that we saw through July, that we are going to see through July 2024, will keep prices lower, especially if we end up having a warmer than normal winter. But just looking out, right, there's kind of two trajectories that we could see as the surplus turns into deficit in 2024. The blue dots there down at the bottom of the screen, those are, I wouldn't call them an anomaly, but in summer 19, winter 20, we had bonkers associated gas production. The Permian was growing. There was all this oil coming out of the ground, and to capture and essentially produce the gas that was associated with it was zero cost, right? So the market was indifferent about whether we were running a deficit or a surplus, right? The question is that going to occur again, right? So if you see the trajectory of those red dots, is the market prepared to make assumptions around associated gases return, especially as we see oil prices that are being sustained above $80 per barrel, right? An important kind of thing to consider. Alternatively, right, would the red dots track with that fitted line there from summer 22, winter 23? That's a different case. My inclination is that as the surplus turns to deficit, we're going to track somewhere in the middle. And our price forecast is representative of that, right? Something that is $3 to $4 range bound as far as Henry Hub goes. But I just wanted to give you guys a little bit more insight on how we look at price and how our supply and demand predictions essentially inform our storage levels, which then helps us be more predictive around price. So something to pay attention to as we go forward. Let's look at that in a different way, right? We are currently predicting that storage inventories will finish this October at 3795. That's about 170 BCF above where we are right now, at least until tomorrow, when the EIA makes another announcement. But this is roughly 185 BCF above the 5-year average, right? So going back to that last graph, right? That's a price equivalent of, call it 260, right, at Henry or so. So we think that's a healthy level. But again, we're lower in terms of Henry Hub than the forward curve is by about 34 cents or so. And I'll show you that explicitly, right? So our October 23, end of October 23 here is here, sitting at like roughly 270, 265. We get out to March 24, we think we'll be at a surplus of about 149 BCF, right? Which in our equation, our model equates to about a 267 handle at Henry. But this is assuming that normal weather scenario that I plotted out earlier. This red line here, what this red line essentially plots out is if that warm winter scenario shows up. And you can kind of see there with inventories, they're landing at about the 2 TCF mark, as opposed to, right around 1.7 or 1.8 TCF, where it would land kind of normally in our base forecast, right? So again, winter's scary surprise is that this, the surplus to 5-year average, right? What if it's closer to 500 BCF? What does that mean for price? How scary is that? And what kind of, essential near-term recoil are we going to see, from that scenario if it does indeed pan out? So, like I said, watch your weeklies. Watch our natural gas weekly, which comes out ahead of the EIA storage report. Watch our macro supply and demand, which is a monthly publication that is, basically running with this all winter. So, from a near-term perspective, we're on a little bit of a roller coaster ride where, provided a warm winter shows up, prices are going to have to get worse before they get better. And so, it's just something to be aware of, be cognizant of going forward, especially as we approach winter season. So those are our kind of our main conclusions, right? You can see I snapped a photo of a roller coaster here, kind of a creepy looking one too. But in any case, this is going to be the situation. Volatility is going to be rule of day. Not just at Henry, but obviously at different basis locations throughout the lower 48. So near term, that downside risk in prices is the main story, right? If you want to learn anything about Haynesville and Permian, I've added a couple links here. Haynesville in particular, I think is extremely interesting. We have what we call our Arklatex Basin S&D report, which if you have not looked at, please check out. It's actually going to be going through a revamp here, and we're very excited to dive into that in a little bit more deeper fashion. So those are kind of the highlights of the next 6 months, right? Short term, storage moves to a deficit, right? Once storage moves to a deficit, again, the only cure for low prices is low prices, but production's got to rebound. Essentially in the back half of 2024 in particular, right? And to what extent will that rebound involve associated gas? Kind of yet to be seen. Much more dependent on a crude oil price there, but we do see some supportive signs coming out of the Permian, which could lead to higher associated gas volumes coming out of there. So that production rebound, even though we haven't had the real production decline yet, the production rebound is kind of the story of call it the last Q4 of 2024. So that's something to pay attention to there as well. And then long term, of course, is the LNG puzzle, and we know that we need more pipe, more infrastructure to really exploit that. Is it a field of dreams scenario? Like if you build it, they will come. Is it chicken and egg? But I would expect that another evolving storyline as we look out into 2024 is the announcement of projects and the intent of developers to essentially service that LNG demand in growing LNG in demand in 25, 26, and 2027. So that is the end of the show. I'm going to jump out of presenter view here and see what kind of questions we got. Also on the screen here, we'll send this out. You can take a picture of that QR code to sign up for our daily note and other daily energy insights. And then, yes, this session will be recorded. And so, yeah, we'll send that out as well. It'll be available, I think, probably through a link, right? Yeah, obviously you can, kind of replay it and grab some screenshots at your leisure. So, yeah, we'll provide that as well. Okay, let's get on some more questions here. I'm just kind of scrolling through, and let's see here. Here's a good one. How will LNG certainty of supply issues impact demand for gas volumes from the Anadarko Basin from the Barnett? Well, that's a good question. I noted that there's nothing wrong with the Anadarko or even the Barnett, right? We just consider them a tier 2 type of basin, right? Those tier 2 basins, which I think extend into the Rockies, certainly DJ, Powder River, areas like that, and Canada, all of those tier 2 basins are going to have to step up in 25, 26, 27. The load is just too much. Especially for other regions of the country, right? So if you're pulling, even if it's just 9 or 10 BCF a day of incremental gas to the Gulf, right? That leaves other markets short. So, the ramifications from this are pretty severe, right? Your Chicago markets end up being short. They're competing with gas that's going to the Gulf. California, Phoenix, those areas are competing for those same molecules. And so Anadarko, which has a kind of direct linkage there to MidCon markets, is extremely important. Even the Northeast could possibly be left short if it doesn't grow. So I think growth out of Anadarko and legacy Barnett is incredibly important as we look out later in the time frame, essentially to backfill production from Permian and Haynesville that is all going to be rushing to the Gulf. So yeah, that was that question. Let me go through here. Let's see here. Power demand has been higher year over year by about 2.3 BCF a day, but you only show a year over year winter increase of 0.1 BCF a day. Do you anticipate power demand abates this winter relative to last winter? That's a good question. That 0.1 BCF a day of growth that we saw is based on last winter, which was a pretty high power burn winter to start. And we, given some of the baseload capacity figures, We couldn't get it up really any higher. Um, I still think in a warm winter scenario, you're going to need it. And so, in short, my answer is um, it could certainly be elevated given what we've seen uh, this summer, right? This summer's, the growth and power burn didn't factor into our winter forecast, but I think there's potential there for it to be anywhere from zero point 0.5 to even close to 1 BCF a day higher, which would negate some of the impact from rescom demand maybe not coming in as high. So that's a very good question. Of course, with all things, the forecast is a little fluid, but I think that power burn is certainly something to monitor this winter as well. So appreciate the thought in the question around that. Let's see a few more. Is there a way to monitor your supply and pricing projections? Well, of course. I mentioned it before, that macro S&D product. It comes out once a month. We release it. It actually went out this morning. So we release it on the first day of bid week every month. And what it does is it really helps our clients kind of, look at our viewpoint, at least for the next couple seasons looking out. Helps them make decisions on, whether to hedge, how much to hedge, maybe how much to lock in during bid week, what percentage of their either production or their need. So macro S&D, if you're interested in a trial, feel free to reach out to our guys. And you'll see a lot of the similar slides to what I just presented. So that's a great question as well. Let's see. How do you define Haynesville and East Texas in your Arklatex view? Well, Haynesville is obviously the lion's share of the production in Arklatex, but East Coast and some of the East Texas, Fayetteville, and some of those legacy basins, for example, Barnett, also constitute our Arklatex view. But the main driver there, really, of growth and or decline is the Haynesville, as the kind of the lion's share of that Arklatex production region. All right, a couple more questions here. It's at 10:43, and so I think we'll do about 5 more minutes of questions. And then, of course, if I don't get to your question, feel free to email directly, and we can get to you that way. All right, here's one. Will the average break even of tier 2 gas basins skew the relationship between storage deficit surplus and price, as shown in your graph? Will new pipeline capacity from Marcellus have the opposite effect due to lower break evens? Well, I think obviously the lower the lower the break even, right? So you looking at the Marcellus, right? The lower concern the market should have when we do enter deficit territory in July 2024. Now these tier 2 basins that on average will have higher break evens, how does that impact the relationship between storage deficit and surplus? That's a pretty good question. You need $3 or $3.50 or even $4 in a basin in order to support growth there. That short situation that we're approaching in 26 and 27 will certainly push prices to the level where tier 2 basins are going to have to activate. It'll promote activity in those basins. Obviously we track that through our midstream activity tracker, which essentially plots rigs by system. And so as we see the rig count grow and we see where specifically the rig count growing and on what systems, we'll be able to monitor that in essentially real time. So yeah, with the average break-even price being higher in those tier 2 basins, you do have to wait maybe a little longer for the price signal. But I don't think that there's any doubt that LNG demand is going to lift prices, especially in the Gulf. So if you're a producer and you want to target the Gulf, or alternatively you want to target, say, the Mid-Con market because prices are going to be going up there, then that's an important thing to pay attention to. Let's see, any more questions here? Do you see downside risk in prices this winter due to pipeline constraints, including the fact that MVP now won't be online until end of Q1? I think one of the things that we're going to see, it's not necessarily a pipeline constraint issue, but if we do end up having a warmer winter, you're going to be constrained by the amount of gas that that you can, I guess that you can move around, right? That maybe isn't coming out of storage. So usually, when we look at the Northeast, right, you can see a production pop during periods of cold weather. It didn't happen last year because you didn't have periods of cold weather. So will pipelines be constrained around, essentially moving that production around? I think it's specific to certain areas. So that's a good question. I think I probably need to look into it a little bit and get back to you with a full answer. So with a lack of demand, I think overall the environment could be that there will be some fuller pipes, and without MVP or their delay until Q1, we never forecast that MVP was going to fill right up, and so it's less of an issue in our mind, because we did come out and say, hey, MVP is not going to fill right away. So it's less of an issue maybe than others might tell you, but overall, you're going to see some pretty full pipelines if demand doesn't show up. I think we got time for one more question. Yes. If you have a below consensus near-term view on Henry Hub, how much additional incentive to gas-weighted producers, do gas-weighted producers have to drill their richer acreage in 24 and 25 than in 23? If we're thinking that Henry Hub prices are, our base case at 270 in March and potentially lower if we have a warm winter there, right? I think there is a little bit of incentive to maybe not high grade, but kind of select your most, for lack of a better word, your most productive locations in 24, right? So you're going to want the wells. You're going to be targeting areas that have higher IP rates in general, because that reduces your margin cost there. So I think you will see a little bit of that in 24, especially if prices are below consensus, as we could very well see. So good question. I think that's a good way to wrap things up. Thank you all for being with us. Appreciate it. And again, use that QR code that you see there, and then we'll make sure that a copy of the presentation is available for you all to view. And thanks for spending a part of your morning with us. We really appreciate it. And again, any questions or follow up, we have email. You can reach me. I'm JWEIXEL @eastdaily.com. and that's daily, DALEY.com. So feel free to reach right out and look for some more correspondence from us as it relates to this webinar, and we will see you or speak to you soon enough. Thanks, everyone.